Glencore's latest H1 earnings surge arrives at a pivotal moment for commodity markets and global inflation. When a trading giant reports rising profits, it signals momentum across copper, coal, zinc, and oil, even as supply chains adjust to new demand patterns. Investors watch earnings tempo closely because a single company can reflect broader cycles, stronger markets, improved producer discipline, and the ability to weather volatility. This surge matters beyond a single ledger line. It shapes capital flows, affects mining investments, and hints at what elevated commodity prices mean for budgets, inflation expectations, energy security, and the real economy in coming quarters. Glencore reported a pronounced rise in earnings for the first half as demand for key commodities remained resilient and supply discipline tightened. In plain terms, higher prices and efficient operation boosted margins across its diversified mix: cobalt, copper, zinc, coal, and oil. The company benefited from rising smelter margins, favorable currency effects, and a leaner cost base after years of investment in inventory and logistics. Investors care about the math behind the headline because the story boils down to three levers: stronger selling prices, controlled production costs, and the ability to move tons efficiently through a complex global network today. Background to this surge stretches back to years of capex in mining and logistics, and to the long cycle of commodity prices that swing on demand, supply disruptions, and policy shifts. Glencore emerged from an era of turbulent markets, building scale through acquisitions, commodity trading, and a vast asset portfolio. Historically, earnings cycles tend to follow price trends, with profits expanding when metals are in favor and contracting during downturns. The firm has weathered price spikes, strikes, sanctions, and exchange rates, which taught it to optimize hedging, diversify suppliers, and manage debt. That legacy helps explain today's earnings trajectory and risk appetite. Across markets, the earnings beat has reinforced a shift higher for commodity peers and related equities. Copper neared multi-year highs, while coal and oil benefited from supply constraints and demand resilience. Traders priced in a steadier growth path for miners, with credit conditions easing in some regions as revenue confidence grows. Currency moves helped profit translation for a global player. Banks highlighted improved earnings quality versus cash burn, and ETFs tracking energy and metals collected fresh inflows. Yet volatility remains intact, as geopolitical headlines and policy signals remind investors that inventories, seasonality, and climate rules can abruptly alter demand. Industries most exposed include miners, energy producers, processors, and chemical makers. Glencore's peers in copper and coal benefit from shared price strength, while renewable and infrastructure players watch grids and metals pricing for project economics. Consumers feel the ripple through higher material costs, delayed construction, and cautious capex in sectors ranging from automobiles to consumer electronics. Hedge funds and pension funds recalibrate risk budgets, reweight commodity equities, and shift toward higher dividend yields and inflation hedges. Sovereign wealth funds monitor currency and fiscal resilience, balancing exposure between resource exporters and importers amid shifting terms of trade. Supply chains tighten as buyers wait for clearer signals. On the macro stage, interest rates, inflation trajectories, and energy policy frame every move. Higher metal prices feed inflation fears, prompting central banks to calibrate policy with caution. Geopolitics add risk premia in supply chains, sanctions, and rare earth dependencies. China, Europe, and the United States all influence demand cycles through manufacturing, infrastructure spending, and green transition targets. A commodities rally can buoy national budgets for resource-rich economies while pressuring importers with higher input costs. As macro data improve, investors assess the durability of price strength against seasonal demand swings, inventory cycles, and the policy environment shaping trade and logistics. Smart money is rebalancing toward resources with visible pricing power and resilient demand. Large pension schemes and sovereign funds have added exposure to diversified commodity baskets while trimming cyclicals with higher beta. Banks grade credit for miners more favorably as margins stabilize, supporting new equity issues and project finance. Retail traders spread capital across exchange-traded products, futures, and thematic funds that promise inflation hedges. Timings matter. As volatility spikes around headlines, investors seek clarity through longer time horizons and disciplined risk rules. Across the board, the message is caution paired with selective conviction in resource exposure. Investors also monitor liquidity and liquidity risk. Risks remain that could mute the earnings glow or reverse the rally. A sudden drop in demand from China, policy tightening, or a surprise supply glut could compress margins quickly. Currency headwinds, higher financing costs, and aging mines threaten profit durability. A climate policy pivot might curb coal demand or shift to cleaner energy sources, eroding some pricing power. Geopolitical flare-ups can disrupt shipments, trigger sanctions, or tighten sanctions on trading hubs. If inventories overshoot, prices could decline faster than expected, leaving investors with stretched valuations and a heavier dependence on hedging strategies. The bear case emphasizes risk control and diversified asset mixes. Investors should stress test scenarios. Retail investors can respond with disciplined, research-driven steps rather than chasing headlines. Start by defining a simple allocation to diversified commodity exposure through low-cost funds or broad miners ETFs, then pair with a separate cushion of cash for volatility. Use stop-loss and position sizing to limit drawdowns during headlines. Follow forward guidance from Glencore and peer results to gauge sustainability, not one quarter. Consider a phased rebalancing approach that scales into strength and trims during weakness. Finally, avoid overconcentration in any one metal or stock and track macro indicators such as inventories, demand signals, and currency trends. Looking ahead, the Glencore earnings surge suggests a sustained tempo for commodity-exposed investors, but with caveats. If demand remains resilient, prices hold, and producers manage costs, earnings momentum could extend into the next reporting cycle. Yet shocks can arrive from policy shifts, geopolitical events, or new supply arrivals that reset expectations quickly. The practical takeaway is to stay informed, maintain diversification, and align exposure with long-run objectives. For viewers seeking actionable insight, this channel offers ongoing market context and practical ideas. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.